And let's start today's class. What we are going to do now is for the first 15-20 minutes, we're going to revise what we did yesterday, and there will be certain questions that I'll ask. Please put in your answers in the chat. It's a revision session for the first 15-20 minutes. Yesterday, we did chapter 1, module 1 and 2. The first module spoke about professional standards and guidelines that help us with our audits and other engagements. So, what is the section reference for statements on auditing standards? SAS. SAS section reference is AU-C. Second question. To whom is SAS applicable? Now we are saying SAS is applicable to non-issuers. Why are we saying that SAS is applicable to non-issuers in case of interim financial statements where annual statements are audited? Why is that caveat mentioned that in the case of interim financial statements only if annual statements are audited, SAS is applicable? If it is not audited, what guidelines should the auditor or the engagement lead follow? In our example, interim financial statements are not audited. Okay. Sorry. Interim financial statements, annual statements are not audited. So SAS is not applicable. Then what is applicable? So in case the annual financial statements are not audited, then SARS is applicable. Please look at the next page where we are talking about SARS, section reference ARC. They are applicable to unaudited financial statements or unaudited financial information of the non-issuers. But in that case, it is preparation, compilation, and reviews. So your interim reviews get covered, but not the audits. So please be careful when you're answering. The answer is right, but I just wanted to make sure that you guys know it is only these 3 type of assignments that are covered by SARS. Okay, now the company that we are auditing is an issuer. They have also received certain subsidies from government for building their manufacturing plant in a underdeveloped area. So it basically brings jobs, it brings a lot of population towards the town. So they have received certain subsidies from the government. You as an auditor are required to audit the financial statements of that company. What are the guidelines that you will follow in this case? You will follow both PCAOB-AS and the government auditing standards because there are government incentives or subsidies that are received. So you'll follow the requirements of both. Okay. Now, next question. You are auditing a government program where the program gives vaccinations to public at large for free or at a subsidized rates. Free for people who are in the lower class and so at subsidized rates for others. What are the auditing standards that you will follow when you're auditing this program? Anything related to the government subsidies, government organizations, programs, activities, or any entities that receive government funds, government auditing standards are required to be followed. Who has issued the government auditing standards? What is the standard setting authority? The standard setting authority is Governmental Accountability Office. Are we clear? Okay. Now, next question. excuse me, you are required to conduct agreed upon procedures based on your discussion with the client for submitting a report to investors on how the ratio analysis of the company looks like. It's a private company. You need to do agreed upon procedures to submit ratio analysis, certification on ratio analysis. What standards would you follow? You are required to follow attestation engagement standards, that is statements on attestation engagements. Now, you are required to audit, or no, you're required to provide a review of financial statements, which is not an interim review, it's an off-cycle review for the purposes of a bank, and it is an issuer. What are the standards that you're going to follow? You are an issuer, and the auditor is required to issue a review report, which is not an period end or a quarter end or a year end review. It is an off-cycle review. For the purposes of a bank, they need it. The bankers need the report, review report. What are the standards that you're going to follow? Now, there is a confusion here. Initially, people wrote SARS, which is absolutely incorrect. SARS cannot be followed by issuers. Please note, SARS is applicable only to non-issuers. You cannot use SARS if it comes to the issuers for any kind of reporting. Okay. Now, SARS is out of picture. It is eliminated. We have another two evaluations to do. PCAOB-AS or SSAEs. Now, under PCAOB-AS, this can fall under the special reports bracket. Maybe. Under SSAEs, this is a review of a subject matter, which is the ratios or the working capitals, which is the responsibility of the third party, and the auditor or the accountant is reviewing it. Maybe falls under SSAs. Now, we need to look at the question in detail. If it is done by the auditor, then PCAOB-AS will kick in. If it is done by the accountant or any other CPA firm, then SSAEs will kick in. Now, why? Auditors are required to file a report for any kind of reporting that they do on the company that they have registered for. Now, this can be a bank report. This can be anything else. They are required to follow SSAEs. Sorry, they're required to follow PCAOB-AS. If they are contracting not as auditors of the company, but as independent accounting firms, then SSAEs will kick in. In the given example, this report that they are required to issue, which is a special report, which is not a requirement under PCAOB to be issued. Special reports, which are the requirements of PCAOB, something like your shelf prospectus, something like your proxy filings, something like forms 16s for our section 16 officers, form 4, sorry. All that is governed by PCAOB-AS. This is governed by SSAEs. Are we clear how we determined SSAEs are applicable? In the given case, the report that we are required to issue is not a special report under PCAOB. That is why it is not covered under PCAOB-AS. It is covered by SSAEs. When you go back and listen to this class again, it will make more sense to you. when they engage the auditor to do the audit, reviews, or special reports. Special reports are all the reports that you file with SEC or for the purposes of the audit. You need to understand what kind of report. That is why I mentioned in the question that this is a report which is off cycle. It is not a period end, quarter end, or year end. It is not a report that is required by the filers. It is required by the bank. It is a subject matter which is the responsibility of third party and you are doing the review. So SSAs will come into play. Okay, moving on. What is the most authoritative guideline for an issuer? PCAOB-AS is the most authoritative guideline for an issuer. Okay, next question. As members of a CPA firm, what are the quality control standards that you will follow? What is the guideline for that? ET is a section reference for professional conduct. I said we are a CPA firm. What are the quality controls that we will follow? So you have to follow statements on quality control standards, SQCS. Please look at the question 3 or 4 times when you're doing your MCQs. You have to look at the keywords. If you look at the keywords, you will be able to eliminate all wrong options very, very easily. The question said, you are a member of a CPA firm. What are the quality control standards that you are required to follow? Not professional conduct. So if it is not professional conduct, then you have to use SQCS. At a member level, if they're asking professional conduct, then it is ET. The question for most authoritative guideline for issuer was given, not non-issuer. So that is why people responded with PCAOB-AS. If the question is for non-issuer, then SAS is applicable. Okay, moving on. All right. We are an audit firm. We've received an inquiry from a client, prospective client, sorry, to conduct an audit for the year ended December 2023. What is the first step that you will take in this process of onboarding a client? You would first conduct an assessment of the objectives of the engagement. That means you will understand from the client what is the objective of the engagement and then determine the client background check run. Based on that, you will determine the potential risks. You will understand if the risks are worth taking, independence within the organization, and then send it to your risk team for clearance. Once cleared by the risk team, you will fill out the engagement acceptance form, which has the risks, the background checks, the independence, and the objectives of the engagement all included in one. If it's a continuing client, you do engagement continuance and client continuance form. Are we clear? Now, what are management's responsibilities when they are preparing for the audit? What are the management's responsibilities? There are 3 responsibilities. What are management responsibilities? Management has 3 responsibilities. 1, preparation and fair presentation of financial statements in accordance with applicable financial reporting framework. Design, implementation, and maintenance of internal controls over financial reporting and fair presentation of financial statements. Providing auditors with an access to information and persons within the entity needed to complete the audit. Okay, now we are conducting an audit of a company where the materiality for now assume is $100,000. You are concluding your audit and you found that management is not willing to give you explanation for certain entries aggregating to $1,000. How would that impact your opinion? Okay, now this has two ways of looking at it. One, management is not willing to give you access to entries and they're not willing to give you explanation. That may result in scope limitation. But the scope limitation is not material. Again, if there is a scope limitation and management is not willing to help you out, it raises doubts on the management's integrity. So the auditor, generally in this situation, what is done is the auditor performs additional procedures to ensure that there is nothing that is missed or nothing that looks fishy, to determine that this is truly immaterial and then let it go. If in the same example, there were entries aggregating to $110,000, then the situation would change because it becomes material enough for them to conclude that there is something wrong and there is a scope limitation. Everybody agrees? Makes sense? Please remember, audit is very, very judgmental. Conclusions are professional judgment driven. And always make sure if there is a doubt, you perform additional procedures to cover the risk. Overdoing audit procedures is not wrong. It is just not profitable, but not wrong. Underperforming audit procedures and not covering the risks is wrong. What are the objectives of an audit when it comes to an issuer? What are the objectives of an audit when it comes to an issuer? You need to perform an integrated audit for an issuer. So you need to make sure the financial statements are fairly presented and provide reasonable assurance around that. And also perform an audit of internal controls over financial reporting, whether those controls are operating effectively or not. If in the process of your audit, certain auditing standards cannot be followed. For example, you're required to audit an estimate, but you're not able to audit that estimate in accordance with the standard, then it is a scope limitation and that will preclude you from conducting an audit or giving an opinion. Any questions so far? Okay. Before we start with module 3, now let me give you a little background. Then we'll take a break for 10 minutes and then we'll come back and we'll start with module 3. And we go non-stop till the class ends. Starting module 3, we are going to talk about different types of audit opinions that are issued in different situations for an issuer and a non-issuer, and how it changes the report format in certain situations. Now, a lot of people who are new to audit would be wondering, why are we talking about the reports first as opposed to what is required to be done in the audit? How does this make sense? You need to first see what is going to be the output of the entire audit process, and then backtrack from there to see what kind of procedures are required to be performed. And that is why first we look at our opinions. Then we go into how the audit is planned. Now, going into the audit, if it's not a continuing client, you don't know whether what kind of opinion you'll be issuing. But you already know the client background, you know the industry in which they operate, so you know what procedures are required to be performed. And on an iterative basis, your nature, timing, and extent of your audit procedures will change. But your final output, certain sections will remain same. Certain sections will require modification. Basically, your opinion may change as the audit progresses, but you will know from the start how the opinion looks like, and you make tweaks to it. From an unqualified opinion, you may go to modified, etc. We'll go into all the details starting module 3. Now, module 3 to module, one sec, let me go back. 8 are extremely important for your exam, very, very heavily tested. They like giving you simulations, they like giving you MCQs on these topics, and very easy to understand once you follow the concept. If you know one type of audit report, it is just then modifying it based on the situation or the type of issuer or the type of um, misstatement that you find. Are we clear why we are looking at reports first? Okay, let's start. We were talking about audit reports and not other reports. At the end of the auditing of the company, we issue a report whether the financial statements are material, whether it makes sense or not. When we are forming an audit opinion, what we need to do? What are the types of opinions that we issue? Can you guys still see? I'm getting comments on Zooming. One sec. Give me 1 minute. Let me try zooming in. Okay, I think this should work. Let me start sharing again. Okay. All right. When we are talking about the audit opinion, the auditor needs to take into account two things. One, whether they have obtained sufficient appropriate audit evidence in accordance with the auditing standards, and whether the financial statements are in material respects in accordance with the applicable financial reporting framework. Now, what does this mean? The auditor is going to issue opinion on two things. One, gap issues, that is financial statement related issues, or gas issues, audit related issues. Now, When we are talking about the financial statements related issues, that means either there is a accounting policy mismatch, or if there is financial statements that are not prepared in accordance with the right gap, all that will be checked by the auditor to make sure that it is right or not. The auditor evaluates the financial statements are adequately disclosing the significant accounting policies selected and applied, including description of applicable financial reporting framework. The accounting policies are consistently applied. Estimates and disclosures are made by the management that are reasonable. Information presented is relevant, reliable. Terminology used is appropriate. Overall structure of the financial statements is correct or not. And whether the financial statements are achieving the fair presentation rule or not. Now, very important pass key. It impacts all our types of opinions. Before we go to this very fancy and very nice chart that I like, the auditor refers to auditing standards for guidelines on how to perform an audit. That is the auditor's guidelines. The auditor refers to the gap to evaluate whether the transactions are recorded and reported fairly in the financial statements. Auditing standards to see how to perform audit procedures. Gap to see if the transactions are recorded and presented correctly in the financial statements. Now, this is a very important chart. If in case before your exam, you do not have time to revise the entire chapter, then you can just look at this and your notes and you should be good. Okay, now, when we are talking about financial statements, we are going to talk about two ways, whether they are in accordance with GAAP and whether you were able to audit it or not. If it is in accordance with GAAP and you were able to audit it, then there is no issue found. That means you're going to give a clean opinion, which is called unmodified or unqualified opinion. Anything else other than this is a modified opinion. If it is a financial statement issue, that means if you have a gap related issue, accounting estimates made by the management are not appropriate. It is a gap issue. If you are not able to audit the accounting estimates made by the management, then it is an audit issue. If it is a financial statement issue, then there are two types of opinions that can be issued: qualified or adverse. In case of qualified opinions, when is it applicable? The impact is material but not pervasive. In case of adverse, impact is material and pervasive. Audit statement, impact is material but not pervasive. Qualified, impact is material and pervasive. Disclaimer. Now, let's hold. What do you mean by pervasive? When we talk about, we know what is a material impact, right? My materiality threshold, let's take an example. We are auditing the books of a company ABC. Our materiality is $10,000. During the course of audit, we noted that the company's depreciation policy that they are following is not in accordance with GAAP. That means, let's take another detailed example. Laptops, due to the technology issue, generally have a depreciation life of 3 years. That means, if you're taking a $900 laptop, you will amortize it over 3 years. You will take 300 depreciation over 3 years. That is as per GAAP. But the company has taken a stand that due to wear and tear, they are going to use a different depreciation method, which is not in accordance with GAAP. Then the auditor will determine the impact. Now there are a lot of laptops in the company, lot of employees. The impact of under depreciating or over depreciating is, say, $11,000. It is material. It is impacting only my depreciation account and my fixed assets account. It is not impacting any other caption or element of my financial statements. So it is material but not pervasive. Same company, you're auditing the cash accounts. You are not able to see you are looking at cash accounts. The company is required to follow accrual basis of accounting. They have followed cash basis of accounting. If they do that, that means the impact is not only on their cash and bank, it is on all the captions of the financial statements, all the line items. The impact is material and pervasive. In that case, you will give adverse opinion. Do we understand the meaning of material but not pervasive? Material and pervasive. That is what I explained. What is pervasive? Pervasive means it just does not impact one caption, it impacts multiple lines of your balance sheet and income statement. In the example that I gave, instead of following accrual basis of accounting, the company followed cash basis of accounting. Then in that case, it is not only impacting my bank balance, my cash balance, it is impacting my AR, my AP, every single line item of the balance sheet is impacted. Are we clear? Material and pervasive. If it is immaterial, it cannot be pervasive. If it is immaterial, it cannot be pervasive. First test is whether it is material or not. Then the second test is whether it is pervasive or not. How can an immaterial impact be evaluated for pervasiveness? Okay, this is financial statements related issues. Let's talk about audit issues. Can everybody please put themselves on mute? All right. This is about financial statements related issues. We'll go through the text in the textbook. Let me talk through and make you understand what the issues look like. Now, same example, laptops. It is material but not pervasive. Management believes that their estimate is correct. They are sure, but you are not able to audit that estimate because you do not have enough evidence to prove that management's estimate is right. You will give qualified opinion, material but not pervasive. Now, it is material and pervasive in cases where you're not able to, for example, audit cash and bank. If you cannot audit your cash and bank, cannot perform audit procedures like cash count, bank reconciliation statements, subsequent bank statements check, then you don't know whether the bank balance that's stated at the end of the year is right. One. Two, whether the transactions in all the accounts are recorded correctly or not, because your bank and your cash determines the other entries, right? Everything is routed through your bank and cash. So if you don't know whether that's right, you don't know whether the entire balance sheet and P&L is making sense. So the impact is material and pervasive. Since you're not able to audit it, you will give a disclaimer of opinion. Disclaimer is generally related to scope limitation. Are we clear? Are we clear, everyone? Okay. Now, let's backtrack, go into what are the opinions and what is the nature and how it is presented. When we talk about unmodified or an unqualified opinion, unmodified term is used for non-issuers and unqualified term is used for issuers. When we are giving this kind of opinion, we are saying that the financial statements are fairly presented for the financial position, for cash flows, and the results of operations. It is fairly presented in all material respects. Mehak, I'll give you examples for qualified report as we go through. Please give me some time. In certain circumstances, auditor may determine that it is necessary to add additional communication, even though there is an unmodified opinion. You want to give some more explanation to the users of financial statements. That is when you add emphasis of matter paragraph and explanatory paragraphs. You're not modifying your opinion. You're still giving unmodified and unqualified opinion. Unmodified for non-issuers, unqualified for issuers. Non-issuers use emphasis of matter paragraph and issuers use explanatory paragraphs to give additional information which is relevant for users to understand the financial statements, but it does not change your opinion. Are we clear? Okay. Now, let's go to material or modifications to the audit opinions. There are three types of modifications that can be made. Under audit issues and financial statement level issues, one is qualified opinion, which is common in both. A qualified opinion states that except for the exception that you noted, financial statements are fairly presented. Except for that one error, except for that one material misstatement that you found, everything else is right. In case of an adverse opinion, financial statements do not present fair presentation. In case of disclaimer, the auditor does not express any opinion. In adverse, you're giving an opinion that it is not right. In disclaimer, the auditor does not give any opinion. Okay. Now, when you're giving an adverse opinion or a disclaimer of opinion on the financial statements, you cannot give a clean opinion, that is unmodified or unqualified opinion on single financial statements. You cannot say my complete set of financial statements are wrong and say there is clean opinion on my statement of operations, on my cash flows. You cannot give two different types of opinions in case you're giving adverse or disclaimer. Are we clear? Very, very important pass key. In case you guys are noting it, please star mark important pass key. Are we clear, everyone? Shall we move on? Okay. When we are giving adverse opinion or a disclaimer of opinion on the financial statements, we cannot give clean opinion on single set of financials. What does your complete set of financial statements include? Balance sheet, income statement, cash flow, equity roll forward, and the notes to financial statements. Now, when you're saying that there is an adverse opinion or a disclaimer on the complete financial statements, you cannot give another opinion that my cash flows is clean. That is a contradicting opinion you cannot give. Second, what do we mean by emphasis of matter paragraph or other matter paragraph? When we talk about emphasis of matter paragraph or other matters, the auditor feels, or based on the professional judgment, they believe that there is certain information that needs to go in the audit opinion, but it is not modifying their opinion. It is just giving the users additional understanding of certain elements of the financial statements, making sure that they are aware. It goes in emphasis of matter paragraph or explanatory paragraph. For example, in our depreciation, the example that I gave for depreciation, management said they are following a different depreciation policy. Auditor was able to audit it. Auditor accepts the estimates made by the management, but the impact is so material of using a different estimate that the auditor believes it should be highlighted in the audit opinion so that the users of financial statements know that the depreciation used is a different depreciation policy or estimate as opposed to the standard. Then they will disclose that and say it is not an exception. We are going to talk about emphasis of matter paragraph and other matter paragraphs in detail in a separate chapter. Are we clear? Very important topic. Please ask me any questions you guys have. Okay. Now, okay, let's stop for a minute. I cannot turn off the chat because students are asking questions and it's very important to clarify doubts as we go. I cannot hold off doubts till the end of the chapter and then students are confused. So please bear with me. The chat is going to be on. I need to answer questions and make sure everybody understands. students who are talking ahead because they already know the concepts, I'm not even looking at those chats. I'm only answering the questions that people have on the current topic. So please bear with me. Second one, there are certain slides that are provided in the new feature, but I prefer using the textbook. Slides gives you the synopsis. I believe this is a better way of teaching because I'm walking you through each and every concept in the textbook. At the end of the day, you will not read the slides. You will read the textbook. If you guys prefer me using the slides, which I don't like, I can still do that. But I think this is more detailed and it is very important because we have a mix of students who are new. Please let me know if you guys want me to use the presentation. I can do that. I looked at the presentations. I found it very, very brief that I will not be able to teach also. Okay, moving on. Let's go back to the summary of different opinions. Now, we will talk through each opinion in detail, how it looks for issuers, for non-issuers with examples. Now, we are going to talk about a summary of all the opinions. If there is no material misstatement, materiality is not a problem, then you give an unmodified or an unqualified opinion. If it is material but not pervasive and it is a financial statement issue, then you give qualified opinion. If it is an audit issue, you give a qualified opinion. It is material and pervasive, you give adverse opinion in case of financial statement issue. If it is material and pervasive and you are not able to obtain sufficient appropriate audit evidence, you give disclaimer of opinion. You are not able to audit certain captions, material and pervasive, you will give disclaimer. It is related to scope limitation. Disclaimer of opinion means you are either limited by the client or you are not able to audit or you're not able to obtain sufficient evidences to say it is free from material misstatement. Scope limitation is not always client imposed. It can be that it is inherent by industry that you cannot audit, or it is that just the client does not have details to give you. Scope limitation. Are we clear? Okay. Now, if there are issues with gap and auditing standards, very good. I'm not sure who asked me this question, but very, very good question. I was waiting for one student to at least ask, what if we have both issues? If you have both issues, your opinion paragraph, okay, if it's material but not pervasive, it's still going to be qualified opinion. You're going to give two paragraphs stating one, this is a financial statement issue. Second, it is an audit issue. We're good. Material and pervasive impact. You have two different types of opinions. Hold. In the entire life cycle, I have seen only one client where adverse and disclaimer was given together. In this client, it was a hospital industry. The client was in debts. The client was not able to give us evidences. And there was a liquidation process after the year end that was put in place. Now, you will say contradictory opinions. You're not giving any contradictory opinions here. You're giving adverse and disclaimer together. It's material and pervasive. There's a financial statement issue. There's an audit issue. Contradictory opinions are when you're saying there is this issue, but some clean opinion on another financial statement. No. Here you're saying there are both the issues. It was not a public company. It was a private company. So I don't even have the audit opinion to show it to you guys. But this was the partner's opinion that we need to give adverse opinion on the financial statements, saying that the financial statements should follow liquidation accounting, which was not done. And two, we were not able to audit a lot of things because it went into national NLCT procedures. So you cannot access the books. So it was also scope limitation. So adverse opinion on the financial statements and disclaimer because you were not able to audit. Now, this was the partner's opinion. And going concern is also an issue. So this was sent to our national risk team. If you have such a complicated case, you do send it to the risk team for clearances. And if you're disclaiming that you're not able to audit, then you will not know if there's a financial statement issue. We just did not disclaim the fact that we had books limitation. We said we cannot do any procedures because of that. And that is why at the end, it was decided to give disclaimer. You cannot give both together if it was this situation. But in other cases, you may be able to give adverse opinion for one caption and say disclaimer when you're saying you're disclaiming the entire financial statements. When you're saying disclaimer, all the financial statements are disclaimed. So you cannot do anything more than that. There is a very good guidance in India for this kind of reporting. I'm not sure if it's still applicable. This was way back in 2017, 2018. So this was a very interesting one, which turned out to be a disclaimer at the end of the day, because you're just saying that you're not able to do anything on the financial statements. If you're saying that, then how are you saying there's an adverse opinion? Do you understand why disclaimer is superseding adverse opinions? Do you guys understand? Very interesting audit. It was okay. I had done the audit under Indian GAAP. Same rules follow. Disclaimer is disclaimer even in India and in US. So make sure that your concepts are clear. As per location, my disclaimer conditions do not change. It is the same. Okay. Now we've spoken a lot about persuasive effects. Now let's talk about how they impact us. They have given us a definition of our pervasiveness. It is not confined to a specific account, element, or item of financial statements. In the given example, when I told you depreciation was only linked to our fixed assets and depreciation, nothing else is impacting. That was confined. When we spoke about cash and bank and we found out that, you're not able to audit it, it is impacting all the elements or different elements of financial statements, then that becomes pervasive. Now, if it is confined, it is a substantial portion of your financial statements. I just have cash and bank, fixed assets, and inventory in my assets, and my cash and bank is wrong, then it is substantial portion of my financial statements. You will determine the percentage of it to the total. And if it is substantial, then it is pervasive. And if the disclosures are fundamental to the understanding of financial statements. This is the definition of pervasiveness. Are we clear? If you're disclaiming the financial statements, that means you're saying there's a scope limitation, you could not audit, and you don't know the impact on different captions. Then you cannot give qualified opinions. You cannot give adverse opinions. You give one opinion, but it is categorized into two issues. You can either have financial statement issues, you can have audit issues, or both. So when you're giving an opinion, you're combining the issues. And you're giving one opinion, but for the purposes of determining what needs to be done, you're categorizing it into two types of issues. Okay. Now, in the next chapter, okay, before we go to the next chapter, last statement in pervasiveness talks about disclosures. Right now, we spoke about pervasiveness only from balance sheet and financial standpoint. When you look at your disclosures, that is basically your footnotes to the financial statements. If my footnote is important for the users and is wrongly stated, then it is pervasive. For example, it is a manufacturing company. It has an inventory disclosure footnote, which talks about purchases, which talks about COGS, which talks about inventory. If that footnote is wrong, then it is not going to help the users to understand how much did they produce, how much is their cost of production, how much is their inventory at the end of the day. So that disclosure is very important given the industry in which they operate. And if that disclosure is wrong, then it has a pervasive impact. Are the examples making sense to you guys? Okay. Let's move on to the next chapter, where now we are going to talk about each opinion from each reporting unit point of view. If it's a non-issuer, if it's an issuer. How does the report look like? What are the contents of the report? And how it is modified, we will talk about it in next chapters. Opinions are going to be the same for issuers and non-issuers, just the reporting format is going to change. Types of opinions are going to remain the same. Format in which they are reported are different. If the auditor concludes that there is no material misstatement in the financial statements, the auditor will give unmodified opinion in case of non-issuers and modified opinion, unqualified opinion in case of issuers. Now, let's look at non-issuers first. What we'll do is we'll run comparisons between issuers and non-issuers so that you guys first understand the differences. Okay. First, independent auditor's report is used as title when we are talking about non-issuers audit opinion, which is unmodified. Okay, that is the title. Who is the addressee? The people who have engaged you to conduct the audit. They are the addressees. Then you give your audit opinion. In this section, the auditor will use the heading as opinion. They will mention what are the financial statements. First, the entity's name, the financial statements that have been audited, title of each financial statement, the period for which they are being used, and a statement that in the auditor's opinion, it is fairly presented. In accordance with which framework? Just go through this with me. We'll look at the audit report example also. After the auditor's opinion paragraph, you give basis of opinion paragraph. In this, you will give reference to what is followed by you. If you are conducting an audit in accordance with GAS, you will put in that. A reference is made that you have made your opinion in accordance with GAS. A statement that auditor is independent and the auditor believes that sufficient appropriate audit evidence has been used. So first one, title, addressee, opinion, basis of opinion. Next paragraph is substantial doubt about going concern. This is only required to be put in. This paragraph is only required to be put in when there is a doubt or when it is relevant. You will put in the going concern issue and you will put in the auditor's opinion is not modified. If it is modified, then you will not give it your. Then, key audit matters when engaged. We will talk about key audit matters shortly. You are required to include this paragraph only if you are engaged to do so in case of private companies or non-issuers. In case of an issuer, it is mandatory to give critical audit matters. Key audit matters term used in case of non-issuers. Critical audit matters term used for issuers. Optional here, mandatory in case of issuers. Now, what are key audit matters? We will talk about them along with critical audit matters in next page. Give me some time. Let's go through the entire audit report format. After the key audit matters, you'll put in responsibilities of the management for financial statements. What are the responsibilities? The 3 points that we've spoken of in chapter 2, they will come here along with the management's evaluation for doubt or going concern. What are the auditor's responsibility for the audit in the financial statements? A statement that the auditor has to obtain reasonable assurance. A statement that reasonable assurance is a high level of assurance and not absolute assurance. A statement that there is a risk of not detecting misstatement. Again, the auditor cannot do 100% audit. A statement that misstatement is considered material if there is a substantial likelihood of it to influence the judgment. And whether they've exercised professional judgment, skepticism, identified risks, what procedures they did. Other matter paragraphs when it is relevant, other information whenever relevant. and other reporting responsibilities. Signature of the auditor, auditor's address, and date the report. Okay. When do you date the report? The auditor's report is to be dated the day when they finish their entire procedures, they have drawn their conclusions, and they are issuing their opinion. All financial statements are prepared and management has taken their responsibility. This is the final date of the auditor's responsibility. Any changes after this is not auditor's responsibility. Okay, let's look at the sample. Okay, independent auditor's report, whatever addresses you guys have to put. Opinion. We have audited the financial statements of ABC company, which comprise of balance sheet for so and so years, related income statement, changes in stockholders' equity, cash flows, and related notes to accounts in the financial statements. In our opinion, the accompanying financial statements, in all material respect, present financial position of the company and the results of operation and cash flows for the year then ended in accordance with GAAP, generally accepted accounting principles. This is our opinion paragraph. Next one is basis of opinion. We have conducted our audits in accordance with GAS. Our responsibilities under those standards are further described in auditor's responsibility. We are required to be independent and meet our ethical responsibilities in accordance with ethical requirements related to our audits. We believe that the audit evidence obtained is sufficient and appropriate to provide basis of our audit opinion. Okay. Here you don't need to give going concern, so that is why that paragraph is skipped. Responsibilities of management. Management is responsible for preparing and fair presentation of financial statements in accordance with accounting principles and for designing, implementation and maintenance of internal controls and fair presentation of financial statements that are free from material misstatement, whether due to fraud or error. In preparing the financial statements, management is required to evaluate whether conditions exist to raise substantial doubt on the company's ability to continue as going concern in accordance with whatever gap they need to follow. Now, coming to auditor's responsibility. Our objective is to obtain reasonable assurance whether the financial statements are free from material misstatement. Reasonable assurance is a high level of assurance and not absolute assurance. Therefore, there is no guarantee that an audit conducted in accordance with GAS will detect material misstatements. The risk of not detecting from fraud is higher than error, as fraud may involve collusion, forgery, intentional omission, misrepresentation, etc. In performing our audit, we have exercised professional judgment and skepticism, identified and assessed the risk of material misstatement to the financial statements, obtained an understanding of internal controls, evaluated the accounting policies, and conclude whether, in our judgment, there are conditions or events that may impact the going concern. We are required to communicate with those charged with governance regarding the matters, among other matters, the planned timing and scope of our audit. This is what is standard, what you put in. Again, firm to firm, there will be additions. At least this language needs to go in as management and auditor's responsibility, but there would be some additions. Other information if required, and then you will put in your date and sign. Signature of the audit firm, date and sign. sec. Looks like there is something wrong. Can everybody please put themselves on mute? Okay. Now, this is a standard report. You need to understand what are the contents, how is the placement in each report. Now we have done non-issuers unmodified report, right? You are going to do same thing for issuers and then modified reports. So you need to understand placement, what language is put in. You don't need to learn. Key things that you need to know is what is bare minimum management responsibility. In your simulations, they'll give you statements. They'll ask you to place it in the audit report a lot of times. So that is one of the simulations that I've seen that can come. So that is why it's very important for you to know placements, how the audit report flows. Okay. Now, if the audit is conducted in accordance with two standards, then you will write, we have conducted our audit in accordance with GAS and in accordance with international standards of auditing. Our responsibilities under those standards are described in auditor's responsibilities. If you're giving two references, this is how you will give. Are we clear? Okay. Now, this is going a little ahead. We'll go to the passkey. Just give me 1 minute. When you're conducting an audit in accordance with GAS and PCAOB AS, you should use reports used by PCAOB. Amend your PCAOB AS report to state that the audit was also conducted in accordance with GAS. So you'll use the template from PCAOB and modify a little. Okay. Very, very important passkey again. Please look at it. Okay. When examiners require CPA candidates to report on questions concerning unmodified audit opinion, you must remember in case of non-issuers, if it is anything related to auditing standards, it goes to basis of opinion and auditor's opinion. Auditor's responsibility, sorry. If it is anything related to gap, it is management's responsibility paragraph and opinion paragraph. What are they trying to say? They're trying to say that in MCQs or in your simulations, if they give you anything related to gap, it has to be directed to basis of opinion or auditor's responsibility, because that is the two places where it is disclosed. If it is gap, then it is opinion and management responsibility. Let's go back and I'll show it to you guys. For some reason, this is getting stuck. Give me a minute. Okay. In our opinion paragraph, we have given reference to in accordance with generally accepted accounting principles in United States. So this is gap reference here. In our basis of opinion, we are giving GAS reference. So we are going to direct it in case of gap issues here and GAS issues here. What are the other paragraphs that would be impacted? Management responsibility talks about accounting principles. So gap issues will come here. And auditor's responsibility paragraph talks about gas in accordance with gas. So it will be directed here. Okay, we have multiple questions on PCOB, AS and gas. Okay, now when you are required to use both PCOB auditing standards and generally accepted auditing standards, both two set of standards, then you will use the report that is PCOB report and modify it for gas. That means you will use an issuer's report and then modify that it is audited under both. Now, pause. When will it overlap? When you're a private company and you're going for IPO. That is when this situation will come into play. That you're a private company, you're planning to go for IPO, you're required to follow PCOB AS also. That is when this kind of situation comes into play. Okay. Now we are going to key audit matters. Any questions so far? We are still not talking about MCQs. Please hold off your questions on MCQs for later. We are talking about concepts right now. I cannot go into MCQs right now. Any conceptual doubts that you guys have? Okay, let's talk about key audit matters. Now, what is key audit matter? It is whatever we discuss for key audit matters, it is the same for issuers, just called critical audit matters. Okay. Key audit matters are those matters. We will use two different terminologies because they are two different reporting standard setting authorities. They have used different terminologies. Just that is the difference, nothing else. There is no scope differences. Key audit matters are those matters that were most significant in the audit of the financial statements. They are selected from matters communicated with those charged with governance. Entities, in case of non-issuers, have an option of engaging the auditors. If they do not engage the auditors to communicate on this, you don't need to communicate. But in case of a issuer, it is mandatory. Now, what can be areas that are key audit matters? Areas with high risk assessment, areas requiring significant auditor and management judgment, or significant events and transactions. These are the baseline that call for auditors' attention. Let's take an example. We are auditing a manufacturing company. They have high revenue turnover and all the revenue is driven from certain contracts. It's a pharma manufacturing company. So they have certain contracts. One is their intellectual property rights contracts where they can use the technology to manufacture medicines. Second is certain contracts with big distributors who will distribute their goods. Now, these contracts are high risk areas because this drives your entire revenue process. Then they become key audit matters. Please give me some time to explain the example and the entire language, then you will understand. Hold off. Just by reading two statements, you will not understand unless the examples are given. What is a key audit matter is the area of judgment for the auditor. In the given case, if they had, okay, let's change the example. Let's go to an entity which is a cost plus entity. All the revenue is determined from the contract. It becomes important for revenue recognition, plus it determines all your cost. Then that becomes your key audit area or key audit matter for you to report on. A lot of companies have this ASC 606 recognitions that they need to make for revenue. That also is a key audit matter because it is higher assessed risk for material misstatement. There is a significant judgment or estimation involved. When you're reporting key audit matters in the auditor's report, you need to put in the context of the key audit matter, what was identified, and your opinion. Let's go back to the example that we were seeing. One sec, looks like there's a problem loading the page. Sorry, one sec. There's some problem with the page. Okay, I start sharing again. Give me a minute. Okay. When you are engaged to report on the key audit matters, the introductory language should include key audit matters are the matters that are communicated with those charged with governance. Description of each of the key audit matter should be included related to the disclosure, if any, in the financial statements. Why is that matter most significant in the audit? And how was the matter addressed in the audit? The auditor should not communicate a matter in this section when it could modify the opinion. If it is a modification, it will not come in key audit matters. It will go in your opinion paragraph. You will communicate only matters that are most important and are unqualified opinions here. Are we clear? Other matter paragraph is a paragraph, or emphasis of matter paragraph is a paragraph which you're giving voluntarily to say that this is important for users to understand. In key audit matters, you are talking about matters that were most important during the audit. It is so significant that you have to point out and how it was addressed during your audit. You can give CAM only when there is a clean opinion. If there is a modification, you cannot put in CAM. Matters that gives qualified opinion on substantial doubt should go in going concern paragraph, or they should go into opinion paragraph and not in key audit matter paragraph. Now, what is the documentation around CAM? Same kind of documentation that you do for your other audit captions, you will do for CAM. How did you identify that this was a significant and most important area of audit? How did your audit procedures address this area? What were the conclusions drawn? Whether the conclusions drawn have any backup? How is it sufficient and appropriate evidence was obtained? CAM will appear in case of your clean opinions only, because if you're talking about the most important area of audit as clean opinion in CAM and you're giving a modified opinion above, it is a contradictory opinion. And that is why you cannot give CAM if there is a modification. You're saying this was the most important area of audit and it is clean, but there is a modification. That is why you cannot give both together. Okay, let's talk about unqualified audit opinion for issuers. We've seen non-issuers. How does it change for issuers? Your title here is Report of Independent Registered Public Accounting Firm. There your title was Independent Auditor's Report. Every firm that needs to give an opinion on a public company needs to be registered through Form AP. It is going to come in the next page. I will show you how they are registered, but they need to be registered to issue an opinion, and every opinion needs to be filed. So that is why Report of Independent Registered Public Accounting Firm. Addressee is generally the shareholders and board of directors of the company. It is not addressed to the management. There the addressee is whoever has appointed them. Then opinion section. You will write the name of the company, the statements, date that they cover, and the statement that financial statements were audited. And then you will give your opinion whether they are in accordance with GAAP or not, presented in accordance with GAAP or not. Same opinion paragraph as are non-issuers. Basis of opinion paragraph. Audit committee is a subsection of your board of directors. So you cannot address the audit reports to the board of directors. Sorry, to the audit committee. You have to refer it to the board of directors. They just help with the selection of the auditors. Appointment of the auditors is done in the AGM through voting by shareholders and board of directors. They select, appointment is formal. When we come to basis of opinion paragraph for issuers, the difference between this one and the non-issuers is, in case of issuers, basis of opinion paragraph will include all auditors' responsibilities also. Their auditor's responsibility is a separate paragraph. Your auditor's responsibility is included. You will also, let's go through and I'll show you how it works. A statement that financial statements is company's responsibility, management responsibility, auditor's responsibility, and basis of opinion, all clubbed into one section. A statement that auditor's responsibility is to express an opinion on the financial statements based on audit. A statement that PCOB, an auditor is a that the auditor is a public accounting firm registered with PCOB and is independent in accordance with the rules. Here you will give SEC and PCOB reference. There you have no reference to SEC and PCOB. A statement that audit was conducted in accordance with PCOB AS. A statement that PCOB requires the auditor to plan and perform the audit to obtain reasonable assurance. a statement that performing procedures, procedures you performed, examination, evaluation of accounting principles, and overall presentation of your financial statements. Then comes your critical audit matters, same as your key audit matters. Signature, but here it is mandatory to report. Then signature of the auditor. How many years have they been serving the company for? This is not required in case of non-issuers. It's required in case of issuers. Report date. The date on which the audit documentation was reviewed, financial statements was prepared, management has taken responsibility, and sufficient appropriate audit evidences were obtained. That is when is your report date. Let's go to the sample report. Report of independent registered public accounting firm to the shareholders and board of directors of so and so company. We have audited the accompanying balance sheet of company X as of so and so date and related income statement, comprehensive incomes, stockholders' equity, and cash flows for each of the years then ended and related notes, collectively referred as financial statements. In our opinion, they are presented fairly in accordance with GAAP. Basis of opinion. These financial statements are company's responsibility of the company's management. Our responsibility is to express an opinion. Audit was conducted in accordance with PCAOB and we are registered with PCAOB, independent in accordance with SEC and PCAOB. Next paragraph will just state what are the procedures performed. Critical audit matters, signature, serving the company since so and so, and city and date. Now, in case of critical audit matters, same as CAM, you will identify the accounts that are required to be communicated, matters that are most significant, complex judgments, estimates are involved, and there is high risk of material misstatement. For each CAM that you identify, it is not necessary. There is no difference between CAM and key audit matters. Same, different terminology is used. Non-issuers, you need to be appointed to report on that. For issuers, it is mandatory to be reported. For each CAM that is identified, you need to document the principal considerations that led you to determine that the matter was critical, how it was addressed in your audit, and what are the references to the disclosures in the financial statements. If there is no critical audit matters determined during the audit, the auditor will put in the language that there are no matters during the current period that were significant enough to put in critical audit matters. Okay. Documentation is the same. Any other language here that is mentioned, if you're reporting on investments, then you have certain exchange rules that you need to include. If you're reporting on brokers and dealers, there are certain exchange rules that come into play. You are not required to do certain critical audit matters for brokers, dealers, and investment companies. Okay. Now, when we are talking about issuers, we also need to give an opinion on internal control over financial reporting. Management of the company is responsible for the internal control over financial reporting, the design, implementation, and maintenance of internal controls over financial reporting. When management is required to report on the company's internal controls, but such report is not required to be audited, The auditor should not be engaged to perform an assessment. The auditor must include statements in auditor's report in the basis of financial statements. The company is not required to have, nor the auditor has been engaged. Sorry, not sure what went wrong. One sec. The Zoom is not working. I need to reload the page. There is something wrong with the page. One sec. Okay, coming back. All right. Okay, now some of you would come back and tell me that, you know what? You said internal control over financial reporting is mandatory in case of issuers. Now, this paragraph is saying it may not be required. An auditor may not be engaged. Now, let's take a step back. SOX 404 guides our internal controls over financial reporting audit. They require audits under there. Now, there are two types of 404 sections, 404A and 404B. There are certain requirements for you to mandatorily get your controls audited. If your market capitalization, that means your stock's value as of a certain date, and your revenue do not meet a certain threshold, then you don't require to get your audit done for controls. You're not required. If you are over a certain threshold, then it becomes mandatory. Plus, under the Jobs Act, smaller reporting units is one new feature that has been introduced. If you look at the cover page of the 10Ks, you have to tick whether you're a smaller reporting unit or not. If you're a smaller reporting unit, you also have an exception for a lot of things. And that is why here they are saying if you are not required to report, then the auditor should include that the company is not required to have, nor was the auditor engaged to perform audit on internal controls. As a part of the audit, the auditor is required to obtain an understanding of internal controls over financial reporting, but not for the purpose of expressing an opinion on the internal controls over financial reporting. Most issuers are required to get an integrated audit done. But there are certain issuers that do not require the audit to be done. Okay. Now, same way as in our non-issuers pass key, you have here, if there is a reference to auditing standards, then you go to basis of opinion paragraph. If there is a gap reference, you go to opinion paragraph, because here you do not have management and auditor's responsibility section separately. That is why you need to only refer to these two paragraphs. In case of issuers, if you are required under SOX to give an opinion, then yes, you're giving two opinions. One on the financial statements and two on your SOX compliances. Any questions so far? internal controls over financial reporting is not mandatory for non-issuers. Okay. Under SOX section 404, there are two subsections, 404A and 404B. You are not required to get an audit done under section 404 if you are an emerging growth company. That means you have just gone public and you have less than 1 billion in public debt, 1 billion of revenue, or market capitalization of 700 million or more. If you are crossing these thresholds, then you are required to comply with the SOX requirements. Now, you don't need to remember thresholds. Please remember just section 404A and section 404B. If you do not meet certain thresholds after going public and you are an emerging growth company under the Jobs Act, then you are exempted from SOX compliances. But that does not mean that you should not have controls in place. Controls are still in place. Audit is not required to be done. Stringent compliance with controls is not required even if you're a public company. Okay, required auditor reporting for certain audit participants. Every auditor who is issuing a report for a issuer needs to file Form AP with PCAOB for each audit report issued. This form includes name of the firm, name of the issuer whose financial statements have been audited, date of the audit report, end date of the most recent period of financial statements that have been audited, name of the engagement partner, city in which they have been. It's just the form name. I don't know what AP stands for. I'm so sorry. The city in which the office of the audit firm is there, whether the audit report is dual dated, whether other accounting firms have participated in the audit, signature of the partner. Form AP must be filed by 35th day of the audit report. If it is filed for the first, audit report is first filed in a document with SEC or within 10 days of audit, if the audit report is included in the registration statement. Optional inclusions is engagement partner's full name. For other accounting firms who have participated, their names and how they have audited the sections. Now, let's hold and go back to internal controls over financial reporting. It is a little complex calculation when it comes to newly public companies because they have emerging growth company status for 5 years. So SOX 404 exemption thresholds may or may not apply. You have to evaluate if they are emerging growth companies 1 and then under section 404 if they are exempted. For 404 exemption, you need non-accelerated filers with public float of 75 million or less. Emerging growth companies are the companies that have recently gone public, have 1 billion or lesser debt, have lower market capitalization. They're exempted for 5 years. So there are two different evaluations that are required to be done in case of newly public companies. Four oh four is in your portion, but I just It is just in different chapters of your different subject. I think it was in information technology section where you had different things put together. I don't know how it is in the new syllabus. So I will check that if it's in your syllabus somewhere else, but this is what it is. And for emerging growth companies, yeah, earlier in BEC it was included, but I'm not sure how it is placed in your new portion. For emerging growth companies, integrated audit is not mandatory till the time they cross the threshold or 5 years, whichever is earlier. Okay. Now, let's summarize this chapter. We have done 2 audit reports. One for non-issuer, the other one for issuer. Non-issuer, first comes title, Independent Auditor's Report. Title for issuer is Independent Report of the Registered Public Accounting Firm. Non-issuer addressee is whoever has engaged them. Issuer addressee is shareholders and board of directors. Then comes opinion paragraph. Opinion paragraph, almost similar. You're identifying the company that you have audited, the year ended, financial statements are being identified, and whether they are in accordance with the applicable financial reporting framework. So opinion paragraph, almost similar for both issuers and non-issuers. Then, basis of opinion paragraph, in case of non-issuers, will state all the auditors' gas-related requirements. In case of issuers, it is not only auditors' requirements basis on which they have given opinion, but also management responsibility and auditor's responsibility. In case of non-issuers, after the basis of opinion, going concern paragraph, if relevant, then you have management responsibility and auditor's responsibility, which is clubbed here in issuers for basis of opinion. Then you have signature, you have date and title. In case of issuers, date, since you're serving the company, also comes in. For issuers, you will file form AP by day 35 of the audit report. If your audit report is included in the registration statement, that means in case of IPO, by day 10. Any doubts? Critical audit matters is required to be disclosed. In case of issuers, key audit matters is optional. If you are engaged to do so, you will report. In both the cases, you identify what is the most important, significant area of audit, which involves judgment, which involves complex transactions, where there is technical judgment involved and higher risk of material misstatement. For each of the critical audit or key audit matter, you will identify them, how your audit is addressing them, and how you made sure that it is not wrong. If there is any modification, then key audit matter or critical audit matter will not come. It will go into the modification. In case of a non-issuer, if there is a gas issue, then you will refer to basis of opinion and auditor's responsibility. If there's a gap issue, opinion paragraph and management responsibility. In case of issuers, PCOB auditing standards, then refer to audit basis of opinion paragraph. If gap issue, opinion paragraph will be requiring the references. Any questions so far? Let's go back to chapter 3. Same way, let's summarize all types of opinions. If there is no material misstatement in the financial statements or there is no audit issue, you give unmodified or unqualified opinion. If there is a material but not pervasive impact and it is a gap issue, you give qualified opinion. In case of a material and pervasive impact, you give adverse issue for any financial statements level issue. In case of audit issues, material but not pervasive, qualified opinion. Material and pervasive, disclaimer of opinion. When you're giving a modification on complete set of financial statements, you cannot give a clean opinion on a single financial statement. That means if you're saying your financial statements are not fairly stated or you're disclaiming them, you cannot say statement of cash flows is unqualified or unmodified. What do you mean by pervasive? It is not limited to only one element of your financial statements or one account of financial statements. If it is limited to one account, that one account is so substantial that it will cover most of your assets or liabilities. For example, cash and cash equivalents, inventory, and accounts receivable are three captions that make up your total assets of $100,000. If your inventory is wrong and it is $70,000 out of the $100,000, 70% is already wrong. So then it becomes pervasive impact. Third condition where it becomes pervasive is where it is a disclosure, which is very important for the users, and the disclosure is wrong. Then it has a pervasive impact. Any doubts so far? Let me stop sharing and please tell me if you guys have any doubts. 2 chapters done today, 2 chapters done yesterday. Any doubts so far? Okay, let's go to the question for chapter 3. I'll display the question. Give me a minute and we'll go through the question together. Okay. An auditor of a non-issuer being the keyword, concludes that a client's illegal act, which has a material effect on the financial statements, has not been accounted for or disclosed. Depending on the pervasiveness of the financial statement, of the effect on the financial statements, the auditor should express either adverse or disclaimer, qualified or adverse, disclaimer of opinion or an unmodified with emphasis, or unmodified opinion with an other matter paragraph or qualified opinion. 1. It is a non-issuer. 2. Material impact on the financial statements. It has not been disclosed or accounted for properly. Requesting everybody to respond.
Not sure why people are getting confused. Let's pause. Okay, hold. We are saying it has not been accounted for or disclosed. That means it is a gap issue. When, if the question would say that it has been accounted for, but you're not able to audit, then it becomes audit issue. Now, it is a gap issue, it is material. So you either give a qualified opinion or you give a adverse opinion. There is no way you're giving unmodified opinion. So this is out of picture. C is eliminated. D is eliminated. It is a material effect. It is material. So you are giving a modification. So C and D are eliminated. Wrong choices. You have to choose between A and B. Since they are talking very clearly about accounted for or disclosed, it is qualification. Disclaimer of opinion comes into play only if you are not able to obtain sufficient appropriate audit evidence. It is audit related, not accounting related. Are we clear? Are we clear, everyone? Okay. I share my screen again. We'll do audit question for chapter 4. When financial statements contain a departure from US GAAP, it is a gap issue because due to unusual circumstances, the statements would otherwise be misleading. The auditor should express the opinion that's unmodified, qualified, adverse or qualified, depending on pervasiveness. Very, very easy question. Okay, now it's a gap issue. Yes, but if this departure would not be taken, the financial statements would be misleading. That means if you would follow gap, you would mislead because there is an unusual circumstances. Then departure from gap is justified and you give an unmodified opinion. Whenever they say, I don't know why the examiners love this question. It's been asked so many times. Even in my exam in 2017, this question had come. So please remember, if departure leads to proper presentation, if you follow gap and it is misleading, then it is not a problem. It is an unmodified opinion. Are we clear? You can definitely think of adding an emphasis of matter paragraph, but that was not in your option. If it was an option, then I would have gone with that. They never gave emphasis of matter paragraph as an option. Okay. Are we clear with the concepts, why, how everything works? When you're practicing your MCQs during the week, I would request, okay, first, for all 4 modules, For all 4 modules, please make your summary notes. 1. During this coming week, make your summary notes. Second, go back, watch Becker videos, listen to the classes again. These recorded sessions would be placed in LMS portal. Please listen to them again. Come back after a day or two, work on the MCQs of each of the module, and then come to me with questions. All these questions are in your Becker module. They are no more in the textbook. They are placed in the Becker module as skill builder, if I'm not wrong. Please, there are all questions that you need to solve, all MCQs. Make sure that you look at all the MCQs there, solve them, come back to me with questions next week. Next week, we'll talk about modifications to all reports, issuers and non-issuers. Any questions so far? Are we doing okay? Is audit difficult? People who have no experience with audit, are you guys doing okay? Okay, I have couple of requests to repeat my explanation for the last MCQ again. Last MCQ question said that there is a departure from gap, but if gap was followed, it would be misleading. What kind of opinion would you give? The answer is unmodified because your departure from gap is justified. There is a material departure from gap. That means, for example, let's make it easier by giving example. You are required to follow a certain procedure for estimate as per gap. You have not followed, because if you would have followed that, the estimate would be wrong and you are able to justify that as management. Then that departure is allowed and you give an unmodified opinion. The auditor has to agree that the departure is allowed. All right. For people who mentioned it is a little tough because it's just started, stay on after the class. We'll discuss what is the problem. For the rest, please do not worry. We will cover all types of reports next class. People who are finding it harder, please stay back. We can discuss. Thank you all. Please practice MCQs. As you practice, it will become less confusing. Read your concepts well. Thank you all. People who had the question of it being a little tougher, please stay back, we'll talk. Rest can drop. Okay. Please tell me how I can help. Why are you feeling it is tough? It is a little hard. Is it because you guys do not have background on audit? How can your classes be made better? See, if you do not have audit background, it is even more better because your understanding as a clean slate as opposed to people who already have experience. Audit is not tough. You just need to make sure that whatever we are discussing in the class, you might feel it is a little tough, but go back, listen to the lecture again, listen to Becker videos, practice MCQs, read. That's when you'll get more comfortable. I am introducing new concepts to you guys in the class, and that is why it seems tough in the first instance. It is new. I cannot use Hindi because there are a lot of students of different uh, areas. They would not understand a lot of things. So I'm sorry, I cannot use Hindi. I will keep my English as simple as possible because I think some people are not able to understand vocabularies. I'll keep it simple. But please note that every class you take, it's a new concept that it is being introduced. So it is a little more information. It is a little difficult in the beginning because it's new to you. When you go back, re-listen to the lecture, do your Becker videos, then you may find it a little more easier. If you have a long study gap, please make sure do your topics every single day. These 4 chapters that we did today, please go back, revise daily till the time we meet for the next class. And when I do my revision session in the first half an hour, you will see the difference. You will start finding these concepts a little easier because you've done your homework. You're familiar with the concept. Any new thing seems a little scary in the beginning. Any other thing that I can help you with? The MCQs are in your Becker software. Please look at the Becker software. Any other thing I can help you guys with, please let me know. Best way to remember concepts is writing them down. Make your summary notes, you will remember.